Hai, Assalamualaikum warahmatullahi wabarakatuh and selamat sejahtera. Accounting for inventories. If you find the video is useful, please subscribe, like and share. This final video on this topic is regarding calculation related to ending inventory using FIFO and weighted average method in Perpetual Inventory System. Perpetual Inventory System. Perpetual inventory is an inventory system that records the sales or purchase of inventory immediately and updated as transaction occur. Ini bermaksud, perpetual inventory adalah sistem inventory yang merekodkan jualan atau belian inventory dengan segera dan dikemaskini semasa transaksi berlaku. Prepare a table using this format to calculate cost of goods sold and ending inventory in perpetual system. Perpetual system using FIFO method. With perpetual FIFO, the first or the oldest costs are the first moved from the inventory accounts and debited to the cost of goods sold account. The end result under perpetual FIFO is the same as under periodic FIFO. Ini bermaksud dengan menggunakan kaedah FIFO, kos pertama adalah yang pertama dipindahkan dari akaun inventory dan didebitkan ke akaun kos barang dijual. Hasil di bawah FIFO perpetual system adalah sama seperti di bawah FIFO periodic system. Perpetual system using weighted average method. When using the weighted average method, you divide the cost of goods available for sale by the number of units available for sale, which yield the weighted average cost per unit. In this calculation, the cost of goods available for sale is the sum of beginning inventory and net purchases. Weighted average method is also known as moving average. A new weighted average unit cost will change due to changes in purchases. Example 1. Syarikat Rejab reports the following transaction for the months of April 2019. April 1st, beginning inventory. April 10 and April 20th are purchases. April 18 and April 27 are sales. Total sales for the months is 2,800. Using FIFO and weighted average method in perpetual inventory system, calculate number 1, ending inventory in unit, number 2, the ending inventory in RM, number 3, cost of goods sold, and number 4, gross profit. Perpetual inventory system using FIFO methods. The first step is to prepare a table as per screen. Make sure that the dates are consecutive according to the transaction that took place. Ini bermaksud sila pastikan tarikh adalah mengikut turutan transaksi. Based on the question, April 1st is the beginning inventory. So records the detail in balance column 100 unit times 10 equals to 1,000. The next transaction is on 10 April, that is purchase. So record in purchase column 80 units times 11 equals to 880. So the new balance are 100 unit times 10 equals to 1,000 and the new purchase 90 unit times 11 equals to 880. So the new balance are 1,180. The next transaction is on 18 April, that is sales. According to FIFO method, the first in will be the first out. Between the 100 unit and 80 unit. The 100 unit, that is the beginning inventory, is the first in and will be the first out. So, record in cost of goods sold, 90 units times 10 equals to 900. So, the new balance are 100 minus 90 units equals to 10 units times 10 equals to 100, and 80 units times 11 equals to 880. So the new balance is 980. The next transaction is on 20th April, that is purchase. So record in purchase column, 70 units times 12 equals to 840. So the new balance are 10 units times 10 equals to 100, 80 units times 11 equals to 880, and the new purchase, 70 units times 12 equals to 840. So the new balance is 1820. The next transaction is on 27 April, that is sales 50 units. Between 10 unit, 80 unit and 70 unit, 10 unit is the first in and will be the first out. So the balance of 40 units will get from the 80 units that is purchased on 10 April. So write down in the cost of goods sold column, 10 units times 10 is 11 to 100, and 40 units times 11 equals to 440. So the total sales is 50 units. So the new balance are 80 units minus 40 units equals to 40 units times 11 equals to 440, and 70 units times 12 equals to 840. So the new balance is 1280. So the total cost of goods sold is 1440. That is 900 plus 100 plus 440. For ending inventory units equals to 110, that is 40 unit plus 70 unit. And the ending inventory cost equals to 1280. So, answer using FIFO method in perpetual inventory system. Number 1, the ending inventory in unit equals to 110 unit. Number 2, the ending inventory in RM equals to 1280. Number 3, cost of goods sold equals to 1440. All these answer we can get from the table just now. And number 4, gross profit equals to sales minus cost of goods sold. Sales is 2,800 from the question minus cost of goods sold from the question 3 equals to 1,360. Perpetual inventory system weighted average method. First of all, prepare a table as per screen and write down the date in sequence. On 1st April is the beginning inventory, so write down at the balance column. 100 times 10 ringgit equals to 1,000. The second transaction is on 10 April. That is purchases 80 unit. So write down at the purchase column, 80 unit times 11 equals to 880. So the balance is 4 unit 100 plus 80 equals to 180, and for the cost is 1000 plus 880 equals to 1880. But what about the cost per unit? So you have to calculate the cost per unit as follows. 1000 plus 880, that is the cost, divide by 100 plus 80, that is the unit, so equals to 10 ringgit and 44 cents. Next transaction is on 18 April, that is sales 90 unit. So write down at the cost of goods sold column 90 units times 10 ringgit and 44 cents equals to 939 and 60 cents. So the balance now is 180 units minus 90 equals to 90 units, and the cost is 1880 minus 939 and 60. So the cost equals to 940 and 40 cents. The calculation is as follows. On 18 April, the cost left equals to 1880 minus 939 and 60 equals to 940 and 40 cents. And on 20th April, the transaction is purchase 70 units. So write down at the purchase column 70 units times 12 ringgit equals to 840. Now, when the purchase comes, you have to calculate the cost per unit. Now, the unit is 90 plus 70 equals to 160, and the cost is 940 and 40 cents plus 840. So the cost balance is 1780 and 40 cents. Then calculate the cost per unit as follows. Cost 940 and 40 cents plus 840 equals divide by unit 90 plus 70. So equals to 11 ringgit and 13 cents. And the last transaction is on 27 April, that is sales 50 units. So write down at the cost of goods sold column 50 units times 11 ringgit and 13 cents equals to 556 and 50. So the balance left is for unit 160 minus 50 equals to 110. The cost is 1780 and 40 cents minus 556 and 50 cents equals to 1223 and 90 cents. And the cost per unit maintain 11 ringgit and 13 cents. So now the ending inventory balance in unit is 110, and the cost for ending inventory is 1223 and 90 cents. And cost of goods sold equals to 939 and 60 cents plus 556.50 equals to 1,496 and 10 cents. So, the answer using weighted average method in perpetual inventory system, number 1, the ending inventory in unit equals to 110 unit. The ending inventory in RM equals to 1,223 and 90 cents. Cost of goods sold equals to 1,496 and 10 cents. All these answer you can get from the table just now. And for number 4, gross profit equals to sales minus cost of goods sold. Sales equals to 2,800 and cost of goods sold is 1,496 and 10 cents. So the gross profit equals to 1,303 and 90 cents. Example 2. The beginning inventory at Syarikat Jama Pos Yang Berhad SJSB on 1st January 2020 was 1,000 unit at the cost of RM2 per unit. In January, Syarikat Jama Pos Yang Berhad reports the following transaction. On 9 January, 23rd and 24th are purchases transaction, while on 15, 28 and 30th are sales transaction. Instruction: determine ending inventory and cost of goods sold under a perpetual inventory system using FIFO and weighted average method. Perpetual inventory system using FIFO methods. On January 1st, beginning inventory balance 1,000 unit times 2 equals to 2,000. On 9 January, purchase 1,200 unit times 2 ringgit and 20 cents equals to 2,640. And the new balance are 1,000 unit times 2 equals to 2,000 plus the new purchase 1,200 unit times 2 ringgit and 20 cents equals to 2,640, and the new balance is 4,640. On 15 January, sales 1,200 units. So, the first in will be the first out. The first in is 1,000 unit. So, write down in the cost of goods sold column 1,000 unit times 2 ringgit equals to 2,000, and the balance of 200 units times 2 ringgit and 20 cents equals to 440. So, the new balance is 1,200 minus 200 equals to 1,000 unit times 2 ringgit and 20 cents equals to 2,200. On 23rd January, purchase 800 unit times 2 ringgit and 40 cents equals to 1,920. And the new balance are 1,000 unit times 2 ringgit and 20 cents equals to 2,200 plus 800 unit times 2 ringgit and 40 cents equals to 1,920, and the new balance is 4,120. On 24th January, purchase 1,000 unit times 2 ringgit and 60 cents equals to 2,600. So the balance are 1,000 unit times 2 ringgit and 20 cents equals to 2,200. 800 unit times 2 ringgit and 40 cents equals to 1,920. And the new purchase is 1,000 unit times 2 ringgit and 60 cents equals to 8,600 and the new balance are 6,720. On 28 January, sales 1,200 units. So the first in will be the first out. The first in is 1,000 unit times 2 ringgit and 20 cents equals to 2,200, and the balance of 200 units times 2 ringgit and 40 cents equals to 480. So the balance are 800 minus 200 unit equals to 600 unit times 2 ringgit and 40 equals to 1440, and 1,000 unit times 2 ringgit and 60 equals to 2,600. So the total balance is 4,040. And the last transaction is sales 500 unit. So the first in will be the first out. So write down in the cost of goods sold column 500 unit times 2 ringgit and 40 cents equals to 1,200. So the new balance are 600 minus 500 equals to 100 unit times 2 ringgit and 40 cents equals to 2,400, and 1,000 unit times 2 ringgit and 60 cents equals to 2,600. So the ending inventory cost is 2,840. While the cost of goods sold 2,000 plus 440 plus 2,200 plus 480 plus 1,200 equals to 6,320. So if you want to get the profit equals to sales minus cost of goods sold, calculate the sales first. That is from the question equals to 1,200 unit times 4 ringgit plus 1,200 unit plus times 4 ringgit and 20 cent plus 500 unit times 4 ringgit and 50 cents equals to 12,090 ringgit. So profit equals to sales minus cost of goods sold. Sales 12,090 minus cost of goods sold 6,320. So the gross profit will be 5,770. The answer for perpetual inventory system using weighted average method. On January 1st, beginning inventory balance 1,000 unit times 2 ringgit equals to 2,000. On January 9, purchase 1,200 unit times 2 ringgit and 20 cent equals to 2,640. So the balance are 1,000 unit times 2 equals to 2,000, and 1,200 times 2 ringgit and 20 cents equals to 2,640. So the total units is 2,200 and the total cost is 4,640. After that, calculate the cost per unit. The cost per unit equals to cost divided by unit. That is 4,640 divided by 2,200. So you can get 2 ringgit and 11 cents. That is the cost per unit. On 15 January, sales 1,200 unit times 2 ringgit and 11 cents equals to 2,532. And the new balance are 2,200 unit minus 1,200 unit equals to 1,000 unit. And the cost 4,640 minus 2,532 equals to 2,108 ringgit. And the total cost per unit just take 2 ringgit and 11 cents. On 23rd January, purchase 800 unit times 2 ringgit and 40 cents equals to 1920. So the balance are 1,000 unit times 2 ringgit and 11 equals to 2108 plus 800 unit times 2 ringgit and 40 cents equals to 1920. So the total units are 1,800 unit and the total costs are 4028. So the cost per unit equals to 4028 divided by 1,800 equals to 2 ringgit and 24 cents. On 24th January, purchase 1,000 unit times 2 ringgit and 60 equals to 2,600. So the balance are 1,800 times 2 ringgit and 24 equals to 4028 plus 1,000 unit times 2 ringgit and 60 equals to 2,600. So the total units are 2,800 unit and the total costs are 6,628. So calculate the cost per unit equals to 6628 divide 2,800. The answer is 2 ringgit and 37 cents. On 28 January, sales 1,200 unit times 2 ringgit and 37 cents equals to 2844. So the balance 2,800 unit minus 1,200 unit equals to 1,600 and the cost is 6628 minus 2844 equals to 3784 and the cost per unit just take 2 ringgit and 37 cents. And lastly, on 30th January, sales 500 unit times 2 ringgit and 37 equals to 1185. So the balance are 1,600 minus 500 equals to 1,100 unit and the total costs are 3784 minus 1185 equals to 2,599. And the cost per unit just take 2 ringgit and 37 cents. So the cost of any inventory equals to 2,599 while cost of goods sold is 6,561 and the gross profit equals to sales minus cost of goods sold. The sales that we just calculated before is 12,090 ringgit minus cost of goods sold 6,561. So the gross profit equals to 5,529. Okay, that's all for topic accounting for inventories. Assalamualaikum warahmatullahi wabarakatuh and selamat sejahtera.